Good morning, everyone, and welcome to the Case Chat session on October 8th, 2014. My name is Dean Rogers. I'm the Senior Analyst here at Case & Company. And today we're going to go through some more information regarding the strategies that we talked about last week in our last session, and also show some setups that I've been following for some stocks for the past few weeks. We've talked about Tesla a lot. And then one of the other things that I wanted to show you all is I'm becoming much more active on Twitter these days, responding to various inquiries, but also just going through and doing some of my own analysis and looking for setups that I think are interesting, or markets that I think are interesting, whether those are stock, commodities, energy markets like we specialize in. I've been putting a lot of information out there. So if you want to follow us, I'll show our Twitter handle, which is @CaseGo. So as we all know, trading is very risky. Okay, so one of the things that we've gone through over the past couple of weeks, and I want to try to start tying things in together. We've gone through lots of different methods. We've talked about StatWare and the trading signals that we get from StatWare, our entry system, our exit system, and our stop management or risk management system. We've talked about the same with Case Private Label, which is on NinjaTrader, or CaseX, which is basically the same thing on Bloomberg. Case Private Label will be on other platforms like TradeStation, eSignal, and Multicharts very soon. And we've also talked a lot about the forecasting techniques. Now, forecasting is something that I really enjoy. It's something that we specialize in. We've been doing it very well for a very long time, over 20 years in the energy space. And in the past couple of years, we've really opened up or broadened those horizons into other markets. Because the techniques that we use are technical. It's pure technical analysis. Fibonacci wave projections, retracements, candlestick patterns, geometric formations, all of these great little things that give us clues as to the market's bias, direction, and strength. And we've talked, I've hinted at the idea that, we want to use our indicators to time our entries and time our exits. That's what we really want. That's how we navigate the market, is using our indicators like StatWare or a moving average system or whatever it may be. However, a forecast is a really important part because it gives us an idea of where the market's going. And I think it was Jack, I think it was Jack that a couple weeks ago emailed me and said something very interesting and something that I'd like to share, in that, what I'm really trying to do here is teach people how to be traders and look at trading as a whole, in the sense that we're not just following indicators. We're not just blindly following an indicator that's telling us you need to be long here, you need to be short there. It's not a black box type of system. Now, that doesn't mean that I'm against black box systems or automated trading or anything like that. I know that that's what a lot of people want, and that's fine. That's not something that we necessarily do, but that is fine. That doesn't mean that StatWare or Private Label or CaseX won't work for the trader that wants to trade in an automated fashion or trade a strategy. So we've been talking a little bit about strategies and how we can tie those into the forecast. And the forecasts are really what kind of give us an idea of where the market's going. Are we trading with the trend? Are we trading against the trend? Should we take more risk, less risk? And if we're using multiple bar lengths to trade, which we highly recommend, should we be scaling our trades up, down, or trading at all? There's markets that we may just want to sit on the sidelines. Now, these 4 charts that I have up here are 4 charts that in the past 2 weeks I have commented on in Twitter. Or on Twitter. I have quote-unquote tweeted about these charts. I'm learning all the lingo here, guys. I'm getting fancy. And the interesting thing about these is these are all setups right now. They're setups that, I'm looking at, that people have been talking about. These have been kind of hot topics, hot items, GM, TLLP, which I'm not sure exactly what TLLP is, Hertz, HTZ, and then GoPro. And so we've been talking about these, and a lot of people have been talking about these in the social media space. And I made some comments because there were some interesting setups on these. And I want to start first with GM. because it's got a very classic kind of setup. And this is where the forecasting piece comes in handy, because right now we can see that GM, over this year, okay, basically in late December, it peaked at 41.85. It's been trending down for most of the year. I actually sent this comment out yesterday, and at that point, we had this little miniature double bottom here right around 31.67. Very important support point from what we can see. Now, we're breaking that today, and what's kind of cool is I called for that. All right, and the reason I called for that was because when we look at this move down, this ABC formation, if we do the wave projections for this wave A, the 0.618 target was met right at this 31.67 swing low yesterday. The actual target was, I think, 31.90 or right in that area. And that's important because the studies that we've done and the evidence that we have both quantitatively and empirically indicate that when the 0.618, or what we call the smaller than target, is met, we generally have an extension to at least the 1.00 or the equal to target. So that means that this leg down from 41.85 to 31.70 will be approximately equal to the move down from 38.15 to whatever it may be. And that target is going to be right around 27.80. And that target is important because the 27.80, so the actual target for this equal to move down is actually $28 on the nose. Okay? So what I would do to calculate that target would be to take the difference between 41.85 and 31.70 and then subtract that difference from 38.15. And that's going to give me $28. Now, the 62% retracement of the entire move up from 1872, which is one of the most major swing low, recent swing low, very major swing low that was made back into mid-2012. And we're looking at a weekly chart right now. That 62% retracement is 27.56. So if we look at the midpoint between 27.56 and $28, that's right around 27.75, 27.76. We can round that up to 27.80 just for argument's sake, within a plus or minus 25-cent range. So we basically have a cluster. Now, if we start to take other wave projections down from 38.15, down from 35.14, we see this 27.80 target show up over and over and over again. And you guys have seen me, and I'm not gonna bore you guys with all the details today. But you've seen my spreadsheets where I calculate all the different wave projections. We look for the clusters, both for the wave projections, the retracements, and other factors. So there's a lot right now going for this 27.80. Now, we haven't quite gotten there yet. The low right now on the day is 30.79, but 27.80 is a target that I would expect to be met within the next week or two. And when it is met, that's an area that I'm going to watch very closely for a buy signal as we bounce off of 27.80. When it hits 27.80, I would expect to see a bounce because it's the equal to target and the 62% retracement. Those are huge, huge numbers. That is the equal to target for this entire correction down. So if this move down is truly going to be a correction, and GM for the longer term is going to continue to move up, longer term, then this 27.80 area really should hold, okay, on a closing basis. We might get a move down to $27.50 or even $27, but somewhere right around this 27.80 is really important. So I'm going to be watching that. Now, am I going to buy when it hits 27.80? No, I'm not. I don't enjoy catching falling knives. Not my hobby. It's kind of a bad hobby, in my opinion. A lot of people will, and that's fine. That's a valid strategy. They might buy when they get down to 27.80, and then if it continues to fall, they might try to layer in some more and basically a dollar cost average in or average into a lower price. But to me, that's a strategy that kind of works against the way that I view the markets and my longer term bias. Okay, this is something that me personally would look to be buying for a longer term type of investment. All right, I'm just looking for an entry point. And the first part of that is looking for where the confluence is. And that's what we're identifying here at 27.80. Now, when it gets down to 27.80, what I'm going to want to see is, I'm going to want to see, do we get a divergence on the case peak oscillator or on the KCD? I don't have my indicators up here right now, but if let's actually go ahead and put the indicators on, and I'll take some of this other stuff off. In fact, let's do this. Let's make a clean chart here of GM. Okay. Let's make a weekly chart. Let's go ahead and insert our analysis. Oops. Go ahead and put StatWare on here. Okay. And we can see, okay, we had a divergence back here at this low. Now you can see right now, this is on the weekly chart. As this move down is taking place, the case peak oscillator, we're making new lows and momentum. So that supports the idea that this market should continue to move down. Now the KCD, which is a little bit more sensitive, is actually not necessarily making lower lows in momentum. It is making lower lows in price. So we have a divergent setup. So if and when we get to 2780, which I think we will, and we get a bounce off of that, which again I think we most likely will at least get a corrective bounce off of that, we should see a divergence. We'll most likely see a divergence. And when I see that divergence, that plays into the strategy that we talked about last week, where I'll drop down to lower bar lengths, in this case maybe a daily chart and then some intraday chart, to time my entry and then scale my trade back up. That way, if it's if it's only a corrective move, if the move up off of 2780 is only a correction, I'm not going to be taking a gigantic amount of risk. I'm going to be able to get in on a shorter bar length, hopefully scale my trade up as I get the permissions on the longer bar lengths, which we'll look at an example of that here in a few minutes, for those of you that haven't seen us do that. But if the market fails, if the move up fails and it starts to decline and fall to new lows, well, then I had a minimum amount of risk on. I can cut bait on the trade pretty quickly, and I may even have a little bit of a profit, but at minimum, or really if I take a loss, it's going to be mitigated risk. All right, so that's one of the things that I'm looking for on GM right now. Now that's just, that's one great trade setup, but at the same time, I just want to show you guys how we tie in our forecast with the trading or the timing. Okay. Same thing here on this TLLP. This is one that somebody had mentioned looked like a bullish flag. Okay, so that's the bullish flag would be something. This again is a weekly chart. Nice, trend lines here. It broke the lower trend line, so you kind of squint your eyes a little bit to make it a perfect flag. But then the big thing that I was looking at is it also could be drawn, and this was my counterpoint to this person, was that this dashed line shows us that it could also be a coil. Generally coil formations are formations that could break in either direction. A bullish flag would break higher, but the flag could come back down and try to test, the lower end of the formation again. Coils, on the other hand, are something that basically tell us a breakout is going to take place, and when it does, we're going to get a protracted move in the direction of the break. And in this case, it broke to the downside. And one of the things that I looked at was this wave projection down from the highs. And so this wave here, which comes down from the high of 75.55 down to the low of 64.04, back up to the swing high of 72, the 0.618 projection for that is right around 64.90, okay, the 64.93. Now that happens to also be the 38% retracement of the move up from this 47.40 swing low, which was made back in late 2013. So again, we've got confluence. We've got the smaller than projection, or the 0.618 projection. We've got the 38% retracement. Okay, and we talked about the 38% retracement in the past as being a level that should hold if the move down is just a normal correction. So if this is going to be a normal downward correction, or a very minimal downward correction, let's put it that way, then this level should hold. However, as we talked about earlier, usually when a wave meets that 0.618 projection, it will try to extend to the equal to. Now this is kind of interesting, because I will be watching this 64.90-ish area, 64.85 area very closely, because if the market starts to bounce off of it, we could start to get some buy signals. The problem is that I'm not going to get my divergence, because we're not going to make a new low. So for me to get the type of setup that I am comfortable with, okay, we're going to need to come down and make a new low, which means that we're going to probably need to move down to the equal to target. All right. Now, if it holds this 64.90 area, the 0.618 and 38% retracement, it starts to bounce higher, and then ultimately breaks higher out of this upper trend line, breaks above this upper trend line, and we start getting buy signals, then I would be comfortable buying it. Yeah, I gave up some. You know, I'll probably give up a good $7 there, but I'm taking less risk. Okay, I'm risk adverse here. If it does break this 64.90 area, which it kind of looks like it's going to, the way that it's moving down right now this week, it's got a nice strong down move. We're coming out of this hanging man and so on. So if it breaks that and comes down and tests this area in the next few weeks, we can kind of imagine where the next few weeks would be. Look at this confluence area right in here. Okay, look at this confluence area right in here. It's not perfect, but we've got the 50% retracement, we've got the equal to target, and we've got the lower trend line, which ultimately is going to intersect in this area. So within the next few weeks, probably the next 2 to 3 weeks, if it can break this 64.90, there's a very good chance it's going to test this lower trend line of the flag, keeping the flag intact. We could also see it test the 50% retracement and the equal to or 1.00 projection. And then we'd also have the new lows for a potential setup for divergence. Okay, again, I don't have my indicators on here, but we could see that divergence form. And if that's the case, then again, drop into my lower bar lengths, time my entry. All right. Hertz is awesome. Beautiful 5-wave. Okay, this was one Jim Cramer. Somebody wrote to Jim Cramer, the CNBC guy, and was saying, oh, you said that the car industry, the car rental industry was going to be the next airlines, meaning that we'd have a significant rally, and that the move down for the rental cars was a correction. And Cramer came back and defended his position that this more than likely was a correction, and I have to agree with him. I think the move down, albeit it has been strong, is more than likely long-term, and I'm talking really long-term. I'm talking years here, okay? In the years horizon, going out a couple of years, this is more than likely this move down as a correction. And the reason that I say that is we've got a nice classic 5-wave move up where we've completed wave 3, all right, which was a 1.382 extension of wave 1. So wave 1 started here, okay? That was the beginning of wave 1. Then it came up here, wave 1, and then we have 2, and then 3, okay? Now, one of the rules within Elliott wave is that our 5 waves should break down into sub-5 wave patterns. So we had a nice little wave 1 of 1, 2 of 1, 3 of 1, 4 of 1, 5 of 1. And then for wave 3, we had wave 1 of 3, 2 of 3, 3 of 3, 4 of 3, 5 of 3. Okay, so we've got this great little setup. So that means more than likely we're in wave 4. And wave 4 generally will hold the top of wave 1, okay, which ends up being in line with the top of wave 1 of 3 and the wave and the 62% retracement right here around 1684. So that is probably, if this is going to be a 5-wave pattern longer term, the deepest the correction could go is 1684. However, right now we're looking at 2247. Okay, this 2247 area, we've broken that this week. All right, last week we hadn't broken that yet. This week we did. Right now our low is 2156, so we're about almost $1 below that, 90-something cents below that. This is an area right now I'd probably be watching a daily chart to see, what kind of setups we may have. And we can actually put our indicators on there. Let's go back to our chart over here, and let's change this to Hertz. All right. We've got a strong move down on the weekly chart right now. Nothing set up. Nothing set up here either. Okay, we had a weak divergence that was confirmed last week but then taken out. We've got a setup on the KCD. Okay, so I'd watch this daily chart to see if we get a confirmed bullish divergence. But boy, it's not looking like that's going to happen anytime soon. So this is a prime example of an area where we could be looking, Hertz as it declines. People are looking at it as it becoming a value buy as it continues to move down. At some point here, enough buyers are going to come in to start buying it up and pushing it, putting pressure for it to come back up. And we're basically just right now biding our time and waiting for that. You know, we don't want to be the guy, or at least I don't want to be the guy that's buying right now and then leveraging in and leveraging my position down. That's just not, again, I'm not in the habit of trying to catch falling knives. I am happier watching the market continue to fall, make its bottom, give me an indication that a bottom has possibly been made based upon my my forecast and a combination of the signals that I'm seeing, like bullish divergences on the KCD and KSPO, and then timing my entry in, scaling my trade up, and ultimately getting back to the daily or weekly chart where I can hold a position for that fifth wave, which could lead to a long-term position or long-term investment type of position. Okay, so those are all great examples. GoPro is one I just wanted to, you know, very quickly, you know, I commented on GoPro this morning. Oh, I'm giving away my secrets here. On GoPro here, you know, somebody had commented, and it hasn't been in existence for very long, so there's not a lot that we can do with it, but somebody commented that there was a nice classic bearish divergence on the RSI. We also saw the same thing on the stochastic. Unfortunately, there's not enough history for GoPro yet, on the daily chart at least, for me to use the case indicators. But one of the things I'll be watching for here is for the stochastic. We got a classic setup, but I want the slow K to drop below the slow D as we cross out of the overbought territory. And for me, using classic indicators, that's one of the best signals that I've ever seen. And that is when you're either coming out, your slow K crosses below your slow D as you're coming out of overbought, or your slow K crosses above your slow D as you're rising out of oversold. Very strong signals from tests that we've done and you know, my own empirical observations. All right, finally, I wanted to get to an actual example, okay, for Tesla. And I know we're running short on time here, so I will try to be brief with this. Tesla is one you guys hear me talk about a lot. I like Tesla. I like the company. It's just, they fascinate me. They're interesting. They're in the news all the time. And they've been a strong stock for, you know, a number of years. And so one of the things that I'm been watching was this recent decline, because, you know, I really believe that Tesla is going to probably continue to move up, that this recent move down was a correction. This is a daily chart of Tesla. And so, you know, we're looking at this, we've got, you know, from the most recent major swing low, which was right here, right around 176.82, up to the high of 290.80, okay? I think the exact high was 291.42, so I'm a little off there, but nonetheless. The 50% retracement of that entire move up. You know, I was watching this 38% really closely. When it came down here and made this swing low 249 and bounced, I was, oh, that was, you know, I was looking to see. We didn't have any divergences. We ultimately got, at this point here on this bar, that's when this K, this KCD peak showed up, okay? This KCD peak, we draw the signal at the swing low, but this KCD peak formed here, all right? And so when we got that, that was a time where I'm not a big, I don't like the KCD peaks very much, in the sense that they're good signals for getting out of trades, but not necessarily to indicate strong turns. We looked at those statistics last week. Only about 50% of the time do we hit Dev 1 when we see the KCD peaks. So I think it's like 58% of the time. So with the KCD peak, I'm not real excited about it. You know, we did hit, oops, I'm screwed up my chart here. We did hit that 38% retracement. It bounced, but it really wasn't looking real good, okay? Then it started coming back down. We got renewed short signals, you know, second shorts we talked about. This was one that we actually looked at a few weeks ago and talked about shorting it, and how we could have shorted it up in here if we would have, in fact, I think we looked at it last week. We had this bearish divergence on the daily, so then we dropped into the intraday. We could have shorted the market based upon second signals that we received on the smaller bar lengths, scaled it up to the higher time frame, and then ridden it down. Now, all of a sudden, we're down here right around the 50% retracement. This is 10-1, okay, this is last week when we talked. This is last week's chat, was 10-1. On that day, we had a divergence setup. The next day, the market gapped higher on 10-2 and completed this bullish divergence. Now, we were sitting right at the 50% retracement. If we look at the move down, let me just get rid of this here real quick. And this is a lot easier to see on an intraday chart, but we don't really have a lot of time to go into it right now. But if I look at this move down on an intraday chart, we had a nice 1, 2, 3, 4, 5 wave move down where we met the extended wave C, or the 276.4% projection down here towards the very close to the 235.65 swing low. All right. And then we could also look at this wave down here. This one wasn't quite as good. We didn't quite get to the equal to target for this wave. Okay. So we could still see some downside. So I'm really interested right now in this 265 area. Oops. In this swing high, and I will come back. This swing high that I'm pointing at, 265.60, I am really interested in that. Okay. Let me just mark it. And I will tell you why here in just a moment. All right, so we get this bullish divergence. All right, we can drop down into our intraday charts. Now, the way that we had calculated those intraday charts last week was we looked at the average true range indicator. All right, so we'll insert our analysis technique. We're going to look at the average true range indicator. All right, I usually look over 30 bars. And we had kind of squashed it up just to see, and we had come up with, the range was right around 9, maybe 9.5 points. Okay, so assuming that we're going to use, let's say, 9 as our average true range on the daily chart, our intraday charts, we're going to take 9 and we're going to divide it by the square root of 3, and that gives us 5.2. So we're going to use a 9, a 5.2, and we take 5.2 and divide it by square root of 3, okay? So we're doing a factor of 3. We want something that's 3 times lower. All of this equates to the idea that that we're basically going to use multiple bar lengths for trading, and we'll get into that example here. Okay, so 5.2, we're going to use a 3. So our 3 chart's going to be a 3, a 5.2, and a 9. And I've already set those up. All right, so again, we had our bullish divergence here, indicating that we have a good chance for the market to move up. We're not going to buy based upon the bullish divergence, but rather we're going to drop into our smallest bar length here, the 3-point chart. All right, and this is coming up off of that low. We had our first buy signal. All right, so we have our first buy signal. That's warning us that we could get long. Then we had a KCD peak, a pullback. Now during that pullback, we held our previous swing low, and then we get our second buy signal. When we get the second buy signal, it's first class. It's a blue long signal indicating everything is long, everything is permission long, even our synthetic longer bar length. Good, strong, confident entry. So we take our entry there, we place our stop at Dev 3, and we start to watch this move up. Now notice that we had a weak divergence where we might have pulled stop levels in, but the next bar we moved back up. And then ultimately here we had a peak out and peak out, the green P, and we had the red divergence line that confirmed on this bar right here, as well as a first short signal, and then we get a second short. So on this chart, we would have already been out of the trade. However, we entered here at 1354 on the second. Okay, on the bar length higher, our middle time frame, our fast monitor chart, the 5.2 case bar chart, that's this chart here in the middle. On the third, at 12:30, we had a first class buy signal. Okay, we never got a warning signal or anything like that, but we did get the first class buy signal. So when we get that first class buy signal, we now have permission to scale our trade up to the longer bar length. So instead of holding on the 3-point case bar chart and getting out of the long trade, I am now holding on the 5.2 case bar chart with a stop at Dev 3, which right now is right around 247. Now we're getting a little bit of a move down today. We've already hit the warning line. We haven't quite hit Dev 1, but I'm holding on here. All right, I'm holding on. I've got a little profit built into the trade. Right now, let's see, our entry would have been based upon, let's say, right around the close of this bar, which would have been right around 250.6. So, you know, we're risking about $3 right now, a little $3.50 based upon a Dev 3. Okay, so anyway, so we're watching this chart, and at the same time, we're hoping that the market's going to continue to move up. But the thing that I'm really watching now is I'm also watching my daily chart, because if my daily chart gives me a buy signal, I can scale to the longer bar length. Now, I did get a buy signal, but it was a first-class signal. I can use discretion here. This is where discretion is important. This is one of the reasons that I don't necessarily use an automated trading system. And again, not that I think that they're bad, it's just my choice. I get a first-class buy signal. I could buy here, I could scale my trade up to the daily chart and take more risk, place my stop at Dev 3, and flip my stops, but my stops are going to be below the market, probably somewhere down here towards the swing low of 235. I'm going to take more risk. The challenge, though, that I see is right now I'm not sure if this is just a leg up out of this corrective move. I think longer term I am bullish Tesla. Okay, I am bullish Tesla longer term because this downward move looks corrective in the bigger picture when we look at like a weekly chart. Okay, this is a downward correction. But what I want to make sure of is that I'm not going to get burned by this just being an upward correction. And so I can start looking at things like retracements, and so far it's retraced about 50% of the move down. But this is where this swing high comes in, this 250 or 265.60 swing high comes in. If this market can overcome 265.60, which would have been the top of wave 3 for the 5-wave move down, or the top of wave B for the 3-wave move down that hadn't quite met its equal to target, that's what's got me nervous right now, was this projection here. We met the smaller than, and you know how I was saying earlier, most waves that meet the smaller than target extend to the equal to. That has me nervous because I'm looking for that. So if we overcome this swing high, though, of 265.60, that negates that wave. We then have a bearish failure, and then I'm going to get really bullish on Tesla at that point. So if it can close over 265.60 and I get another buy signal, another L, then I'm going to feel very confident in scaling my trade up to the daily chart, and I will be more than happy at that point to take that extra risk. Okay, so for the time being, I am basically using some discretion here. I'm holding my trade on the 5-point or 5.2 point case bar chart until we overcome 265.60 and I get another buy signal, another L on the daily chart. And at that point, I will then scale my trade up. Okay, that's the point of tying in all of these factors that we've been going over for the past several weeks: the forecast, the signals, and the strategy. Okay, I right now am looking at this chart, and I'm confident that this market's going to try to continue to move up, but I'm not quite confident enough to take the extra risk because I need to see a few more things out of Tesla on the upside, specifically overcoming this 265.60 swing high to give me that confidence. Okay? Okay. Well, again, thank you all for attending, and if you guys do have any questions, please shoot me any comments. Dean@Kaseko.com. Also follow us on Twitter @Kaseko, K-A-S-E-C-O. We're going to be more active in that space, and keep an eye out for our new website, www.Kaseko.com.